Hi everyone. In this video, we'll continue our discussion of the equity method. When the investor's expenditure to acquire an equity method investment exceeds the book value of the underlying net assets acquired, additional adjustments to both the investment account and investment revenue might be needed. The purpose is to approximate the effects of consolidation without actually consolidating the financial statements. More specifically, both the investment account and investment revenue are adjusted for differences between net income reported by the investee and the amount that would have been reported if consolidation procedures had been followed. This process is often referred to as amortizing the differential because it mimics the process of expensing some of the difference between the price paid for the investment and the book value of the investment. Consolidated financial statements report A, the acquired company's assets at their fair values on the date of acquisition rather than their book values, subsequently adjusted for amortization, and B, goodwill for the excess of the acquisition price over the fair value of identifiable net assets acquired. All of this matters because increasing asset balances to their fair values can result in higher expenses in the future. If it's land or goodwill that's increased, there is no income effect because we don't depreciate or amortize those assets over time. On the other hand, if buildings, equipment, or other depreciable assets are recorded at higher values, depreciation expense will be higher during their remaining useful lives. Likewise, if the fair value of inventory is greater than its book value, then cost of goods sold will be higher when the inventory is sold. When expenses rise, income falls. It is this negative effect on net income that the equity method seeks to imitate. Illustration 12:15 in your textbook explains the difference between the investment and book value of the net assets acquired in the example we discussed in the previous video. The numbers in this example come from illustration 12:14 in your textbook. In illustration 12:14, United paid $1,500,000 for 30% of the fair value of Argent. That implies a 100% fair value of Argent is $5 million. And that's where the numbers on this slide here come from. The fair value of Argent's identifiable net assets is $3,600,000, while the book value of those same assets is $2,100,000. And that's where the fair value and the book value on this slide come from. So looking at this illustration, we can see that United purchased 30% of Argent and their purchase price was $1,500,000. Their share of the fair value of identifiable net assets was $1,080,000, and their share of the book value of identifiable net assets was $630,000. In our example, United needs to make adjustments for the fact that at the time it purchased its investment in Argent, the fair values of Argent's identifiable net assets were higher than the book value of those net assets on Argent's balance sheet. Notice that in the illustration shown here, United paid $1,500,000 for 30% of the identifiable net assets that, if sold separately, would have a fair value of $1,080,000. The $420,000 difference between those two amounts is attributable to goodwill. The book value of 30% of Argent's identifiable net assets is $630,000. The $450,000 difference between the fair value and the book value is attributed to undervalued buildings, $300,000, and land, $150,000. Let me show you where those numbers came from. The buildings are undervalued by $1 million. That's $2 million of fair value minus the book value of the buildings of $1 million. So United's portion of the undervalue of the buildings is $300,000. That's the $1 million difference times 30%. The same analysis should be applied to land. Land is undervalued by $500,000. That's the $1 million fair value minus the $500,000 book value. So United's portion of the undervalue of the land is $150,000. That's the $500,000 total undervaluation times 30%. Notice that the other identifiable net assets are not undervalued. Their book value and fair value are the same. So United's share of the entire undervalue of the identifiable net assets is attributed $300,000 to the buildings and $150,000 to land. And that's where these numbers in illustration 1215 came from. Now let's see what adjustment, if any, United needs to make for these differences. When Argent determines its net income, it bases depreciation expense on the book value of buildings on its own balance sheet. United, however, needs to depreciate its fair share of the fair value of those buildings at the time it made its investment. To account for this higher amount of depreciation expense, United reduces investment revenue as if Argent had included the additional expense in its own earnings. As shown on this slide, the book value of Argent's buildings is $1 million and the fair value is $2 million, which creates a difference of $1 million. Assuming 10-year life of the buildings and straight-line depreciation, United must recognize $30,000 of additional depreciation expense each year for 10 years, calculated as follows. Fair value of the buildings, $2 million, minus book value of the buildings, $1 million, equals $1 million of fair value excess in the book value. United's 30% share of the excess equals $300,000. $300,000 divided by 10 years equals $30,000 of additional expense per year. Had Argent recorded the additional depreciation in its income statement, United's portion of Argent's net income would have been lower by $30,000, ignoring taxes. So, to act as if Argent had recorded the additional depreciation, United reduces investment revenue and reduces investment in Argent stock by $30,000. Debit investment revenue, $30,000. Credit investment in equity affiliate, $30,000. Let's see if any other adjustments need to be made. Land is also undervalued on Argent's books, but land is never depreciated, so no adjustment is needed for the land. The book value of other net assets is the same as the fair value of those assets, so no adjustment is needed. Goodwill is never amortized, so no adjustment is necessary for goodwill. Therefore, the only adjustment required in this simple example is for extra depreciation on the excess of fair value of the buildings over the book value. In our example, there was no difference between the book value and fair value of the remaining net assets, so we didn't need an adjustment for those. However, that often will not be the case. For example, Argent's inventory could have had a fair value that exceeded its book value at the time United purchased its Argent investment. To recognize expense associated with that higher fair value, United would need to identify the period in which the inventory is sold, usually in the next year, and in that period reduce its investment revenue and its investment in Argent stock by 30% share of the difference between the fair value and the book value of the inventory. If, for instance, the $1 million difference between the fair value and the book value had been attributable to inventory rather than buildings, and that inventory was sold by Argent in the year following United's investment, United would reduce investment revenue by 30% share of the difference, $300,000, in the year following the investment. In summary, an equity method investor needs to make these sorts of adjustments whenever there are revenues or expenses associated with an asset or liability that has a difference between book value and fair value at the time the investment was made. Obviously, this illustration has been simplified by assuming the investment was acquired at the beginning of 2021, entailing a full year's income, dividends, and adjustments to account for the income effects of any differences between book value and fair value on the date the investment was acquired. In the more likely event that an investment is acquired sometime after the beginning of the year, applying the equity method is easily modified to include the appropriate fraction of each of those amounts. For example, if United's purchase of 30% of Argent had occurred on October 1st rather than on January 3rd, we would simply record income, dividends, and adjustments for 3 months, 3/12 of the year. This would result in the amount shown in the T account on this slide. Also, our illustration assumed that the investee earned net income. If the investee reports a net loss instead, the investment account would be decreased by the investor's share of the investee's net loss. Well, that's all for this video. In the next video, we'll conclude our discussion of the equity method.